Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: What is fiscal policy? Fiscal policy is a critical tool used by governments to influence the economy's overall health and stability. It involves adjusting government spending levels and tax rates to monitor and influence a nation's economy. The primary objectives of fiscal policy are to achieve sustainable economic growth, reduce unemployment, and maintain price stability. By strategically managing these economic levers, governments can mitigate the adverse effects of economic fluctuations and promote long-term prosperity. Government spending and taxation are the two main instruments of fiscal policy. Government spending encompasses all expenditures by the government, including infrastructure development, public services, defense, and social welfare programs. On the other hand, taxation involves the imposition of levies on individuals and businesses by the government. These taxes can take various forms, such as income tax, corporate tax, sales tax, and property tax. The balance between these two instruments determines the overall stance of fiscal policy, which can be either expansionary or contractionary. An expansionary fiscal policy occurs when the government increases its spending or decreases taxes to stimulate economic activity. This approach is typically employed during periods of economic downturn or recession. By increasing government spending, the government injects money into the economy, creating demand for goods and services. This, in turn, can lead to job creation and higher income levels, thereby boosting consumer spending. Similarly, reducing taxes leaves individuals and businesses with more disposable income, encouraging them to spend and invest more. For instance, during the 2008 financial crisis, many governments around the world implemented expansionary fiscal policies to revive their economies. The U.S. government, for example, enacted the American Recovery and Reinvestment Act of 2009, which included significant increases in government spending on infrastructure projects and tax cuts. Conversely, a contractionary fiscal policy involves decreasing government spending or increasing taxes to cool down an overheated economy. This approach is often used when there is a threat of inflation or when the economy is growing too quickly. By reducing government spending, the government can lower the overall demand for goods and services, which helps prevent the economy from overheating. Similarly, increasing taxes reduces disposable income, leading to lower consumer spending and investment. A historical example of contractionary fiscal policy is the fiscal consolidation measures implemented by many European countries during the sovereign debt crisis in the early 2010s. These measures aim to reduce budget deficits and public debt levels by cutting government spending and increasing taxes. Fiscal policy's effectiveness depends on various factors, including the timing, magnitude, and specific areas of government intervention. The timing of fiscal policy measures is crucial because the economic impact of government spending and taxation changes can take time to materialize. If the measures are implemented too late, they may not achieve the desired effect. Additionally, the magnitude of the measures must be sufficient to influence economic activity significantly. Small changes in government spending or taxation may not be enough to counteract a severe economic downturn or curb runaway inflation. Moreover, the specific areas of government intervention play a vital role in determining fiscal policy's success. Targeted spending on infrastructure, education, and healthcare can have long-lasting positive effects on economic growth and development. Investments in these areas can enhance productivity, improve the quality of the labor force, and create a more conducive environment for businesses to thrive. For instance, research has shown that public investment in infrastructure projects can have a high multiplier effect, meaning that each dollar spent by the government generates more than $1 in economic activity. Fiscal policy is also influenced by the government's budgetary position, which can be in surplus, deficit, or balanced. A budget surplus occurs when government revenues exceed expenditures, allowing the government to save or pay down existing debt. A budget deficit, on the other hand, occurs when expenditures exceed revenues, requiring the government to borrow money to finance the shortfall. A balanced budget is achieved when revenues and expenditures are equal. The choice between running a budget surplus, deficit, or balanced budget depends on the prevailing economic conditions and the government's policy objectives. For instance, during times of economic recession, running a budget deficit through increased government spending or tax cuts can help stimulate economic activity and reduce unemployment. However, prolonged budget deficits can lead to a significant accumulation of public debt, which can pose long-term challenges for fiscal sustainability. High levels of public debt can increase borrowing costs, reduce the government's ability to respond to future economic crises, and potentially lead to a loss of investor confidence. Conversely, during periods of economic expansion, running a budget surplus or maintaining a balanced budget can help prevent the economy from overheating and reduce the risk of inflation. It also allows the government to build fiscal buffers that can be used during future economic downturns. For example, many countries ran budget surpluses during the economic boom of the late 1990s and early 2000s, which provided them with the fiscal space to implement expansionary measures during the subsequent financial crisis. The impact of fiscal policy on economic growth and stability is also influenced by the interaction between fiscal policy and other macroeconomic policies, particularly monetary policy. While fiscal policy focuses on government spending and taxation, monetary policy is concerned with controlling the money supply and interest rates to achieve price stability and full employment. The coordination between fiscal and monetary policy is crucial for achieving overall macroeconomic stability. For instance, during periods of economic recession, both expansionary fiscal and monetary policies can work together to stimulate economic activity. Fiscal measures such as increased government spending and tax cuts can boost demand, while monetary measures such as lowering interest rates can make borrowing cheaper and encourage investment. However, if fiscal and monetary policies are not coordinated, they can work at cross purposes. For example, if the government pursues an expansionary fiscal policy while the central bank adopts a contractionary monetary policy by raising interest rates, the two policies may offset each other, reducing their overall effectiveness. In summary, fiscal policy is a vital tool for managing economic activity and achieving macroeconomic stability. By adjusting government spending and taxation levels, governments can influence demand, control inflation, and promote long-term economic growth. The effectiveness of fiscal policy depends on the timing, magnitude, and specific areas of government intervention, as well as the coordination with other macroeconomic policies. Understanding the intricacies of fiscal policy and its impact on the economy is essential for policymakers, economists, and anyone interested in the dynamics of government spending and taxation. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.